Hey guys, super excited to have you in the 3-part mini-series, so make sure that you watch right to the end because I don't want you to miss a thing. As they say, the devil's in the details, and it can be that tiny 1% tweak that makes all the difference. My name is Mark Hutchinson. I've got over 10 years experience in the markets, and we now have over 1,000 active students utilizing this technique that I'm going to show you today. So in the 3-part mini-series, what are you going to learn? Well, the main thing, you're going to learn how to maximize on your profits. This is the biggest reason why people struggle. They cut their trades down short. And this is normally from imaginary barriers within their mind. But what I'm going to teach you today is to stop you from doing that, how to squeeze the trades for longer to truly maximize on your trades. I know you're going to be mind blown when you see how simple it really is. Let's dive in the first part. Hey guys, so now we're going to go into a few examples, and we're going to start off here with Euro Pound. So this is a typical chart which the majority of people trade. So we don't trade like this, we keep things a lot more simple, but some of you might have a slightly messier chart, you might have a slightly cleaner chart, but let's just look at the average, right? So we've got the euro over the pound here. Now, when we look at it from this perspective, the whole point of part of this 3-part series is for you to learn how to maximize on your profits. Now, I want to show you some concepts because each layer here will build on each other. So with euro pound, let's take a look at this on the weekly chart. So on the weekly chart here, we have this overall bigger double top. You may be familiar with this kind of price action. You're looking for selling opportunities. Well, the great thing is we can take price back here. Let's be honest with ourselves. In this moment here, would you take that for a sell, or would you see this as momentum? Would you see this as momentum? It's going to break. Here's resistance if you like. So I'll be waiting for, let's say, a break out, retest, previous support to then go long. Or would you be expecting the sell? What if I told you you could anticipate this sell, and we've been anticipating it for weeks and weeks and weeks? Well, more so in part 2 when I teach you more about math psychology, you're going to learn more about that. But first up, I want to show you the difference between typical entries of what you can capitalize on versus what is really possible within the markets when you're utilizing the Falcon style. See, one of the big reasons why people don't succeed is because they only limit themselves to 1 or 2 trades and they cut them trades down short. So let's take a look at this. I think we could all agree if you're trading a particular style and you did find a sell entry within here, you would see this as your next target, right? This would be your first target if you did find a sell within here, because you would see, right, we've got previous resistance, resistance, resistance. Now this is going to be the area of my target. Well, let's take a look on the lower time frame. So going to the daily firstly, so on the daily chart, again, just to reiterate, would you really be looking for a sell here after that momentum? I highly doubt it. Momentum here, you'd be expecting a breakout retest to go long, where we're actually expecting a sell here. After the next candle, possibly, but maybe not. It's likely you're waiting for a move down, trend change, and then a pullback to retest some sort of indicator or previous resistance or support. And then again, you'd be closing your trades down here. So if we go to the 1-hour chart, let's take a look at that in a bit more detail. So on the 1-hour chart here, if we really and truly look at a typical entry that most strategies will take, it would probably be this one here. So you can see we've broken this trend here, so we've moved down, and then what have we done? We've retested the 1-hour 50 EMA. So this could be an entry point here. Now my issue with that is that not the actual trade setup itself, because this is a trade within Falcon as well. This is one of our setups. The issue is this. Let's say, for example, you do take this trade, you have your stop above the EMA, you're looking at, let's say, maybe 20, 25, call it 25 to be conservative, right? If you was going to get the trade, 25 pips, and your target would be here. So we're looking at about a 5.5% pretty much to this point. So this is, again, this is that resistance point here on the daily, which you'd most likely target because you'd be expecting this to bounce off, or, you know, a good area of closing your trade down. So what do you do in this situation? You either set a profit target, that's fine, still a decent trade at 5.5%, that's if you squeeze that out of it. The likelihood that you won't get the maximum profit and you're trying to hold the trade, and if you do that, you're probably trailing it down to, we'll be generous and say 3%, especially if it starts to break above here, and more so here as well, especially as we break above here, you would not be holding it through that. So let's say you walk away with 3%. Now, it's nothing wrong with the trade. What my issue is, the reason why people fail to get consistency is not the entries or the strategies, because all strategies work to an extent. Some better than others, some are more efficient, things like that. My issue is this: if you're limiting yourself to, let's say, just one position, you're essentially saying that you would have to have been up in the London session at 7 a.m. to get this trade, right? So what if it wasn't in your time zone? What if you didn't get that trade? Well, then you're limited yourself. You're actually going to see a move go. At this point, we go back to the daily chart. Essentially, how many times have you seen these trades go where you're kind of predicting the price and you're saying, right, my analysis is good, but I'm not getting in these trades. So essentially, you're seeing trades like this go from here to here, and you're not in anything because you've limited yourself to one trade. I want you to think about that. That adds up over the year, and there's a big difference between people, whether they're really consistent or not. And that's huge. So what I want to do now is I want to show you the difference, just roughly where we would be getting in terms of this. So for example, first entry, we actually have two entries up here, but we're looking at the first trade up here with the 1, 2, 3 touch, just breaking double top. So we're looking at an entry up here for about a 20 to 25. Let's go 25 to be conservative. 25 put stop at the top. So that's our first trade. Bearing in mind we're holding this for the longer term, which again you're going to learn more in episode 2. But let's say, for example, if we just literally looked at it purely from this point of view and it was a similar area that we got out, that's already the difference between 5.5, 8.2, right? So you can already see the difference. Bearing in mind, we have our next entry, which we would be getting here, but a slightly different way of getting in, but same sort of concept. Let's say we're looking at 25 again, looking at 5.5, let's go 25, right? So about 5.5, just over. And then we're looking at where you're closing the trade down. We're looking at a particular pattern here for more downside. And this is why we're actually moving down. We predicted this way in advance. And we're looking at entries here. We're looking at entries here as we had our entry. So another entry, looking for another sell. So when you're closing your trades down, or potentially looking for buys, we're looking for sells, which is where majority of people are getting caught on the wrong side of the market. Let's say, to be conservative, 30 pips on this one, right? This one probably would have ended up in the break even at this stage, but again, maybe you would have ended in a small profit of a 2.5%. But let's look at all of it, of that area. So we drag that to there. Really and truly, if you're taking more of our, hands-on aggressive style of management, you'd be looking more so like this. So 9.5%, 7%, and maybe 2.5% or 2%, especially as this pulls back here, right? So there's a difference there. These are 3 trades. Now, I'm not saying that you're going to get every single trade. There is a potential entry here as well, but again, we just be the ones that are really clear to see. So just there and then, and bearing in mind there's 2 entries on here on the lower time frame as well, that you've given yourself 1, 2 up there, 3, 4, and there is a potential another one, but there's 4 or 5 versus 1. So what you're saying is, if you're lucky, you get that trade, and if you don't, you miss out on the whole move. So it's not that you're not a good trader, it's not that you haven't got good analysis, but you're limiting yourself and you're closing trades down due to these imaginary barriers where you think, oh, that's a significant resistance, where we don't believe that. We focus on patterns, we focus on structure, and these patterns have been repeating themselves over 30 years of data. I know what I would rely on. I'd rather rely on 30 years of data rather than just something that looks like it's rejected. I could put as many random lines here as possible, and you will find some levels of rejections. Now, I understand some of them are more significant than others, and it's not that it doesn't work, it's just that we tend to find that when we focus on the most recent bit of price action, it gives us the best data and it's the most accurate. So we're focusing on something that's actually going to give us more sustainability and more scalability. So that's that part there. But what I really want you to take away, just for this really simple part, in part 2, I'm going to go into the mass psychology of how we anticipated this before it even happened, so you can start anticipating these trades, so you're not caught on the wrong side of the market. And ask yourself, you imagine just on a percentage difference there, what does that mean to you? How much is that worth to you of an extra maybe 5, 6, 7% per month compounded by the end of the year? It is the difference between you being an inconsistent trader or a consistent trader. It's the difference of you doing the break-even dance or being in +4 or +5 or being -2 to then +7. That is such a huge difference. You already likely have a great analysis and skill set. You just need some key tweaks here to not hold yourself back. So in part 2, very excited to get in. Make sure that you watch all the way to the end because everything's going to build on each other. And I'm very, very excited. I'll see you on part 2. Right, guys, so I really hope you enjoyed part 1, and I'm sure that you've seen your mind blown when you realize how much potential is really in the market when you understand how to utilize these structures. You don't hold yourself back. This is actually one of the biggest reasons that I personally see with a lot of traders. I've coached so many traders now, and it's normally these tiny little tweaks. They actually get into quite good positions, but they cut their trade short or they don't see the bigger picture. So hopefully this is just giving you a bit of an eye-opener, and I'm confident you're going to take tons of value away from this part. So make sure that you have gone through this, you've taken notes, and you've really fully absorbed this concept. When you can truly capitalize on your wins, that is when you really succeed in the market. But the next part, which I'm really super excited to get into, is the mass psychology of things. You're going to love it. So I'll see you in part 2.